So there's a lot of talk out there right now about a housing crash in 2021. A lot of people are calling it a tsunami, that the single family home market in the United States is going to crash in 2021. So, what is going on, and why are so many people talking about a housing crash in 2021? So, a lot of people think that there's a bubble in housing right now, and that housing prices are overinflated, and they're showing a number of charts, um, to support that information. But one of the things is that right now the median home price is actually lower than it was in 2017, but it is much higher than, let's say, 2007, when we reached a peak before the 2008 2009 housing crash, and we are up from that point when we did reach lows. But housing has been on the rise over the last 10 years, 11 years since the 2009 2010 financial crisis. And a lot of people are thinking that the housing crash in 2021 is going to be a lot worse than that because of layoffs and what's going on with the pandemic and businesses closing and things like that. So, a couple of things to think about in terms of the differences between back then and now. And I was heavy into real estate back then, a developer, building, buying, selling, doing all kinds of real estate developments and investments, had a bunch of rental houses, a bunch of commercial properties, and things like that. So, one of the biggest things that's very different now than back then, number one, is the interest rates. So, interest rates are very low right now, which means that you can afford more house. So, naturally, prices are going to go up. Think about vehicles. People are looking at their monthly payment versus the total cost of that property. And right now, with interest rates where they are, they're about as low as they can get. It's cheaper for a lot of people to own a house than it is to rent, or it's about a break even in terms of your payments, taxes, insurance, maintenance, and all that. It's going to equal about what your rental uh, payments are going to equal to own, and then you're building equity. You're paying down a house, even if it doesn't appreciate. At the end of the day, you own it, and it's an asset that you're building cash in versus just renting and not being able to write that off or build any kind of equity. So a lot of people are wanting to buy homes because of that reason, because the interest rates are so low. It just makes a lot of sense for a lot of people. Now, in terms of like home equity lines, so a lot of people are refinancing, pulling cash out of a property. There's a couple people saying don't take a home equity line, don't pull cash out of your property. It's absolutely the best time to do it. If you have equity locked up in your property and you can pull it out at 2.5 to just under 3%, and reinvest that money, or even put it into a savings account. I mean, that's almost like free money. It's we haven't seen inflation above 2% since the financial crisis of 2008 and 9. It doesn't look like we're going to see any real inflation anytime soon. The Fed and Treasury are trying to, well, the Fed is trying to target a 2% inflation rate. They'd like to see 3, but we haven't been able to hit that since even 2009. So that's a couple of things that are a little bit different now than it was back then. And if you think about payments, it's kind of like a car. Cars are super expensive now because people buy payments, not vehicles. And if you look at the correlation to the way vehicles used to be sold, and the financing and the interest rates around that back in 2000, even the late 90s, early 2000s, up into the mid to late 2000s, when the financing for vehicles changed, that increased price points on cars because it was all about the payments. So now you can finance zero interest for 72 months, or you can get very low interest, for 72 months. Back in the day, it was 5, 6, 7, 9% interest for 48 months or 36 months. So it was a very different environment. People could not afford to pay more for a car. So that's the banks and the automobile manufacturers that got together and put that program together. So people think that, hey, zero interest for 72 months, I'm saving a bunch of money. They just pack into the price of the car. So you're paying for the financing just like before on the price of the car. They're just spreading it out for you. So it's just a bait and switch from the automobile industry and the banks. Now, in terms of housing, it's a little bit different. Interest rates are low because of the pandemic and because of what the Fed and Treasury have been doing since 2009, pumping liquidity into the markets through quantitative easing, keeping interest rates low because they have to. So the economy is not great overall. It hasn't been great. It's been fundamentally artificially propped up by the Fed through low interest rates and through quantitative easing. So that's going to continue, especially right now with the situation that the economy's in right now. So the main thing that changes demand for housing, and again, it's all about supply and demand, and it's all about interest rates. And right now, people are conditioned to think that 4% is a high rate of interest for a house. So as long as the rates are in the threes, people are going to continue to buy houses. If we start getting over 4%, that's going to put the brakes on demand for housing. And back in the 2008-2009 crisis, it was 5%. Whenever rates were below 5, the market was hot. Whenever it got over 5, it would shut off like a faucet. Now, the other big difference between 2008 and 9 and right now is back in 2008 and 9, there was a ton of inventory when the subprime mortgage industry collapsed, and that's what really triggered, the crash in the housing market, where all the subprime mortgages and all the financial instruments and exotic loans that were being offered by unqualified borrowers, and those were both owner occupants as well as investors. A lot of that was going on. Real estate prices were through the roof. They were doubling, tripling. We're not seeing that now. So values were going up exponentially back then in certain markets, even 2-3 times. We're not seeing that now. We're seeing prices go up, but it's a healthy increase in terms of the amount of the demand that's out there. So back in 2008-9, people would pay anything for a property because they just thought it would keep doubling and tripling. We've learned that lesson that that's not always true. So now there is a threshold in certain areas for certain properties where people just won't go beyond a certain price point. So it is a seller's market, and depending on location, real estate's hyperlocal, so every market's different, every location's different. In general, in most areas, there is a ceiling that people are willing to go to. Now, there are multiple offers on a lot of properties in a lot of areas because there's very little demand, but at some point, people will put the brakes on and they will not pay. And that's what we've seen with this low interest rate environment since 2008-9. Even though interest rates were record lows, the lending requirements are more difficult now. You have to put money down, you have to qualify, all those things. So it's keeping the market healthy, the mortgage market healthy. And it's keeping prices in check because you can't get people into the market that are artificially overinflating properties, because anybody can borrow money if you have a good credit score. So that's what was going on back then. So there was also a lot of inventory. So in addition to speculators, there were a lot of developers that were developing huge subdivisions. And if you remember back in 2009-10, post financial crisis, there were a lot of subdivisions, especially like out in Vegas and Arizona and down in Florida, with thousands and thousands of homes that were vacant. So they went in and just tore them down and took that inventory out of the market. And people were propping tents up that were losing their houses on the slabs, and they had these tent cities. Some of those might still even be out there. But if you remember, there were huge condo buildings in Miami that were vacant, with thousands, hundreds to thousands of units that were just vacant. And, because there was just too much development, too much building going on. So we're not in that environment now. We don't have an abundance of housing. And in fact, right now, the reports are it would take somewhere around 5 to 7 years, maybe 10 years, to build our way through the demand for housing right now, because you can't get the materials and you can't get the trades. A lot of that's due to the pandemic, but we were already seeing a supply chain constraints and labor constraints before the pandemic hit. So construction timelines were taking longer, materials were costing a little bit more, and things were taking a little bit longer if you had to order them, stuff like that. So that's the other issue, is that we do not comparison, between 2008 and 9 and now, is we don't have an oversupply. We don't have a huge inventory of brand new homes built, ready for people to move in, by the dozens, by the hundreds, by the thousands. And that was going on back in 2008-9 when the financial crisis hit. So we have a healthy inventory level. Actually, it's a bit unbalanced. But again, some markets, there are an oversupply right now in New York City where people are leaving. There's an abundance of apartments available because people are, a lot of people are leaving the city. So you're going to have some pockets in some of the cities like that where people are leaving, but that's just filling and creating demand for other areas where people are going. And that trend's going to continue, depending on how long the pandemic lasts, what the, civil environment looks like in terms of what's going on in some of the cities with protesters occupying certain areas and the civil unrest that's going on. So those are major factors. A lot of people don't feel safe in cities now. But again, it's 100,000 or whatever versus millions of people that live in the city. So it's not a huge, significant amount of people leaving the cities in one particular area, but across the country, it creates a lot of demand for these smaller areas like Tennessee, like, some of the areas in Florida, Arizona, Las Vegas. There's places like that. Um, so the other argument is the unemployment. So a lot of people are saying that because of the high rate of unemployment right now due to the pandemic, that's going to affect housing and create a tsunami in the housing market. And a lot of the people that are laid off right now are renters, not homeowners. So that is affecting the rental market. We're seeing issues there in terms of people that aren't unable to pay their rent. There's an eviction moratorium right now till the end of the year, things like that. So the real effects of that in the commercial multifamily market haven't been felt yet. And that's where you're going to see some real damage. There is a tsunami coming in the commercial and multifamily market in terms of potential defaults and potential, asset values dropping significantly because, those properties just going back to the lenders that are vacant, things like that. So there is going to be some damage there in the commercial real estate world. But in the housing market, there just isn't enough supply right now. There's not enough inventory to meet the demand. And as long as interest rates stay low, that's going to continue to be the case. Now, the key to watch are inventory levels and interest rates. And again, there's certain markets that, like in New York right now, you can get some apartments in certain boroughs, not everywhere in New York, but in certain areas of the city. There's an oversupply of vacant units, so you can really get a good deal. So a lot of people are stepping into those, and there's still pretty good demand in the city for some of those products. It's a lot of the rental supply that's vacant right now in New York, not so much for sale product. I mean, there's a little bit more than usual, but again, not enough to make any kind of a significant impact in the housing market as a whole. There are a lot of people that are in in forbearance and that are behind on their mortgage payments, but it's not a big enough number to where if all those people ended up losing their houses and it went on the market would absorb it based on the demand right now and the normal sales um, rate of houses that we typically see. So in terms of a tsunami or a significant crash in the housing market, single family homes all across the country, you're just not really going to see that in 2021 as long as interest rates stay low and as long as the demand stays high. Now, if interest rates all of a sudden shoot up and we get hyperinflation and the Fed has to jack interest rates up, which they have been saying we're not going to do that for years and years because the economy just isn't on that kind of a path of recovery for real inflation to take place where you need to raise interest rates, and they really can't, because if they did raise interest rates, it would tank the housing market and it would tank the stock market. So the Fed is kind of strapped. They have to keep rates low, and they have to. The only other thing they can do now is to buy assets and pump liquidity into the markets and prop everything up, which includes the housing market. So if we start to see stress in the housing market, which is one of the healthiest industries right now, that's kind of really helping things along, the Fed's going to come in there and prop that up, and so is Treasury. So they'll buy those mortgages, they'll support the banks, and they will not let a 2008 and 9 happen. They're not going to let that happen. So it's just not a big enough issue with the banks at the fundamental level of the health of the mortgage market compared to 2008 and 9. We do not have an overabundance of inventory like we did in 2008 and 9, and it's a very different buyer and borrower now than it was in 2008 and 9. You got to be qualified, you got to have a down payment, and the banks, are not lending money at very high loan to values for anybody and everybody like they were back in the day. So it's just a very different environment, and to think that the housing market in 2021 is just going to crash and lose half its value, and there's this huge tsunami of foreclosures coming, it just isn't going to happen. And right at this point, September of 2020, we're not setting up for that. Now, anything can happen. We're in a pandemic. There's a lot of things going on, so things can change, pretty quickly. But in terms of the outlook right now, it doesn't. The indicators are not there that we're going to see any kind of a huge issue in the housing market as long as interest rates stay low. And if interest rates go up, then that's going to, cool off the demand a little bit, so we can get back to a more normal and healthy inventory level. And you got to remember, a normal housing market in most of the history of the housing market, the average days on market was usually around 120 to 180 days. So we are in a market now where there's no supply and there's tons of demand. So it takes, you're getting multiple offers in days to weeks. If a house sits on the market for 30 days, that's a long time right now. Historically, the average days on market in most areas of the country are 120 to 180. So that is a healthy housing market. That's when you have a healthy supply of housing to the demand is when houses take 3 or 4 months to sell to 6 months to sell. That's normal, that's typical, and that's what you normally see in a regular housing market. And right now we're seeing it happen in weeks, days, weeks, and maybe even a month. Some properties aren't even selling at all. So it's not like every single property in every market is selling in days. They're even in the hottest markets, there's properties that won't sell because they're overpriced. So there is a price threshold that buyers are not willing to go beyond for certain properties in certain areas. So we still have a pretty healthy housing market. There's just a lot of demand. Interest rates are really low, so that's continuing to keep it healthy. So is there going to be a crash in 2021? Is there a tsunami coming in the housing market in 2021? I don't think so. The signs are not there. The evidence is not there. And it's a very different climate, very different environment than 2008 and 9. So watch interest rates, watch inventory levels, and just keep an eye on your market, and you will know how to play any changes and any significant issues or downturns if they do happen.